It's a huge week for bank earnings. Goldman Sachs, JPMorgan, and Wells Fargo kicks things off tomorrow. Joining us now for a preview, Amy Wu-Silverman, head of derivative strategy at RBC Capital Markets, and Greg Branch, managing partner at Veritas Financial Group. Good morning to you both. Amy, I'll start off with you. In terms of implied moves, what are you noticing, particularly since we've seen such a run in financials leading up to earnings season?
Yeah, typically a large portion of financials report in the next couple of weeks, about 50% of the weight of the XLF. So it's interesting to me that in terms of implied moves, Wells Fargo is actually relatively cheap heading into the earnings event. And we've seen a lot of bullish options activity, both in Wells Fargo as well as Bank of America and overall in XLF too.
Would that reading on implied move, Amy, be impacted by the fact that Wells Fargo is up 35% so far this year, and so a lot of the move has already been made?
Yeah, it's a great question. That's certainly part of it, but that also is true of a lot of the other banks. So, there is something kind of specific about that name. I would also say that, there's obviously been a general decline in VIX. It hitting kind of sub 20 levels and staying there, I think, has been really interesting to watch, because historically the first couple of weeks of earnings are actually a place to own volatility, and you're kind of coming into it with volatility having sunk like a stone in the last few weeks.
Greg, I want to get your take on Wells Fargo. Certainly it had a rough year last year, only to recover this year, which accounts for that 35% move so far this year. Do you like that bank, or do you look to others?
I would typically look to others. Look, the net interest margin environment, the net interest income environment, although it will contract for this quarter, will decidedly improve with the yield curve steepening. And so that will lift all boats to some degree. But what we'll see from those that have capital markets, which should show a strong quarter and a strong year, for those that have investment banking, which should be up 20 to 30% in the quarter and should have a strong year, is that those were the most able to provision aggressively, and so they'll benefit from significant releases, but they'll also benefit from strong fee income throughout the year. That's something that Wells Fargo can't lay claim to. So the net interest margin environment improving as it will throughout the year certainly helps all. But I think that there are those banks who are structurally advantaged in terms of their positioning for the year. Such
as like a Bank of America, JPMorgan, more on the regional side, which has seen much more, in terms of performance this year.
Right. For me, it's those large diversifieds that you named. It's the Bank of America's, the JPMorgans, the Goldman, and the Morgan Stanleys. Those are the ones who are well positioned to capitalize on our historic liquidity driving capital markets activity, as well as strong investment banking revenues.
Amy, I did want to pick up on your note of the VIX, because I did think that it was interesting. I mean, yesterday was Monday, and so we're coming off of a three-day weekend. So you saw a little bit of a bid in the VIX, but at the same time, still sub 20. And so I'm wondering, what do you make of this? How unusual is this? And what do you glean in terms of how the markets are positioned ahead of what could be a very interesting earnings season, given what companies might say about margins, about inflation, and their outlook for the year?
Yeah, first of all, we're watching hedging activity very closely to tell us, not really just what the VIX is now, but what the expectations are for the future. It's important to remember that a 20 VIX level was unnaturally high. Obviously, it stayed that way through the pandemic because it's just such a tail event. But, pre-pandemic levels, we were still at a 12, 13 handle. So really, a 17 on a VIX, you could still call that high. To me, it was very interesting that we've seen over, 200,000 calls and call spreads trade on the VIX recently. So there are people saying that this VIX level is too low, it's not sustainable. And then overall hedging activity in the S&P, we measure it through skew, but essentially telling you that there is some hedging demand picking up. That could just be taking advantage of the VIX levels and the volatility levels where they are, or it could be expressing that there is nervousness about this earnings season, about inflation numbers, a lot about what's to come.
Do you have a take on which one it is?
What I say to clients is, obviously, the reflation trade is early when you kind of look back to the decade that we had momentum win. Mm-hmm. But if you want to continue to play that incremental exposure, we like doing it through calls, through call spreads. For instance, in something like financials, using XLF call spreads, or using call spreads in your individual names, because it's giving you leverage at a lower level of volatility, but giving you a little safety on the downside.
All right, Amy and Greg, thanks so much. Appreciate it.
Pleasure to be here.
Joe.